Hey, what's up, everyone? Welcome to another episode of the Winners Ways podcast. So, this episode, we have a guest. We have Matthew Sullivan with us. And with Matthew today, we are going to be talking about real estate. We are going to be talking about investing. And for those of you that have learned or know about HELOC, that's home equity line of credit. Matthew is going to share something different with us today, something that I don't know myself. And this is all about how to get equity out of your home without actually going into debt. So Matthew is going to share that with us. So I'm going to bring in my guest, Matt, so that we can talk more. Hey, Matt, how are you?
How you doing, brother? Great to meet you.
Great to meet you. So if you don't mind, can you tell us about you, what you do, and what my audience will learn from you today?
Sure. Well, first of all, thank you very much for having me on your podcast. It's a real delight to be here. So I'm the founder and chief executive of QuantmRE. And what we do is we help homeowners unlock the equity in their homes without taking on more debt. So that means that they can access their home equity with no monthly payments ever, no additional debt, no tax to pay, and they can spend the money on whatever they want. So
Wow.
For those people that cannot borrow money or simply don't want to borrow more money, we're a very smart alternative to, as you said, HELOCs and mortgages and cash out refinances. And there's one more really important part of our platform, and that is for investors. In the next week or so, we're going to launch the investment side of our platform. So for all those of you who wanted to invest in the equity in single family homes across the US, then our platform will allow you to buy into the equity of owner-occupied single-family homes that are not for sale, and benefit from the appreciation that these homes gain when they go up in value.
That is awesome, Matthew. And I want us to, take a step back.
Yes.
Maybe offer some explanation. And here's what I mean. From what you've explained so far, I think there's an individual side whereby a homeowner will, look into his or her equity and say, hey, I need a certain amount of money. So how much can I get from my home? And there is another side, which is about investing. That's an individual or investor looking to buy into other people's investments. So let's take the first one. You said a homeowner will be able to take equity from his home without going into debt. How does that work, Matthew?
It's a question that we get frequently because it's a relatively new type of financial instrument. Most people are so used to borrowing money secured against their equity that you're absolutely right. The question is, well, how does this work if you're not lending me money? And the answer is we're investors and not lenders. So we invest a certain amount of money with you, which really depends on the value of your home and how much equity you have. So it's an investment that we make in exchange for a share of the potential future value of your property when you come to sell. So what we're saying is, in exchange for cash today, you agree with us that when you refinance our agreement, which you can do at any time without penalty, or when you sell your home, all of this can be in the next 10 years, you'll pay us a certain percentage, a fixed percentage of the value of your home when you come to sell. So we're exchanging cash today in exchange for some of the future value of the property. And because that's an investment, there's no debt. It doesn't go on your credit report as extra debt. There are no monthly payments because it's not a loan. And there's no interest. So in other words, there are no interest payments. So you pay us based entirely on the value of your home when you come to terminate the agreement.
Okay, I got it. So let's say today my property is worth $500,000. And maybe I have maybe like $200,000 equity. That means I'm owing $300,000 to the bank.
Yes.
I will come to you, QuantmRE, and
Yes.
you guys will, let's say I need $100,000. You will be able to offer me that $100,000. I'm not going to be in debt, but that means you own part of my property. That's
Well,
what
actually, it doesn't. It means, well, you're right in one sense that there's no debt, but we don't go on title. We don't own any of your property. And that's really important because as a homeowner, you don't want someone else on title. It's your house. So
Yeah,
you
absolutely.
retain all of your rights and privileges as a homeowner stay with you. So we do go on title, but it's a lien. So we don't go on title as owners. We don't share in the ownership. We're not going to come and camp out in your spare room without you knowing. So we do go on title. We put a lien on title, which protects our investment, but it stays very separate. And effectively, once the agreement is completed, you'll hear from us once every 3 months with a statement in terms of like a servicing statement. But otherwise, you won't hear from us for at least 10 years.
Oh, okay. So now I want to understand the upside for you guys.
Yes.
So the property today is worth $500,000. Let's say in another 5 years, the property has appreciated and is now $600,000.
Yes.
Do you share part of the appreciation, or how do you make money?
Well, do you remember what we said earlier was that what we do is we exchange cash today based on the value today in exchange for a share of the value of the property in the future. Now, we don't know what the value of your property is going to be in the future. It could be more, as you say, but it could be less. So what we agree is we say, if you want $100,000, that's 20% of the current value of your property. Yes. So what we do is we exchange that for 32% of the value of your property when you come to sell or when you come to settle the agreement. Okay. So in other words, it's 32%. That number is fixed. What changes is the value of your property. So your property could go down in value. So let's say in 5 years' time, your property's gone down to 400,000 for some strange reason, then we would get back 32% of 400,000. Or as you say, if it goes up to 600,000, we'd get 32% of 600,000. So we're exchanging 32% of the future value in exchange for 20% of today's value. And that's the exchange, and that's how potentially we make a return. But we also, potentially do share in the ups and the downs as well. So it's not like a loan where they take their money come rain or shine. We are very much more equity partners in the property with you.
Okay, so this is called the home equity contract.
Or a home equity agreement. I mean, it's gone through various different names over the years, but it's either a home equity investment or a home equity agreement. Those are the two names that seem to be much, most prevalent at the moment.
Okay. So now let's talk about the investor side. I think I'm clear on maybe the individual side that will just get some cash of their property. So on the investor side, let's say I want to invest money and participate in home equity contract. Can you walk me through the process?
Yes, and when we create or when we finalize that home equity agreement with you as the homeowner, that creates a real estate asset because it's protected by a lien on title. So it's got a security foundation. Secondly, it's got a return profile. In other words, it's got a promise from you, secured by a lien, that when you sell your property or within 10 years, you will pay us 32% of the value of the property at that time. So what we've created is an asset that has a return that is based on the value of your property. So it's relatively straightforward to value this property or value this asset, because if your property goes up in value, then the value that's embedded in that agreement, in that contract, also goes up. So as a real estate investor, we're always looking for investments that allow us to share in the appreciation of real estate. So that's an equity investment. We also, as real estate investors, look for cash payments and dividends and yield. But this type of investment is very much an equity appreciation play. So there's no rent, there's no yield, but the flip side to that is that there's no tenants, toilets, termites, and trash to worry about. So your investment is looked after by the best steward, which is the owner.
The owner.
And so what we do is we say, I mean, the average investment that we make is around $150,000. So that's normally a bit too much for the average investor to sort of bite off. So we use our platform and we use blockchain technologies to take that real estate asset and tokenize it and then fractionalize it, normally into 100 smaller fractions, so that each investor can buy shares in that home equity investment. So what they can do is they can build their own portfolio of maybe a few shares in this house here and a shoe for hairs. There you go. A few shares. There's a Dr. Spoonerism for you. A few shares in this house over here. So that they can build their own portfolio by choosing what houses in which geographies and which states they'll be able to invest in. So they can make direct investments. There are no charges involved because we're not renting the property. So we don't have any of the costs associated with rental, real estate investment trusts. It's a direct investment in the equity appreciation of that home. And then when the homeowner sells, or if the homeowner refinances, the money from that contract flows back to you as the investor, and you then get a cash settlement. So you can then reinvest that money. And the final piece, which is the most exciting piece, is that later on this year, we are planning for you as an investor to be able to trade those investments. So you can make an investment in a fractionalized home equity agreement, and then, again, subject to our current regulatory partners, you'll be able to trade or sell that. So if you've seen your investment go up in value and you want to get some liquidity, you'll be able to go into our marketplace and create liquidity by selling some of your assets, which you can then use to reinvest or to cash out or do whatever you want.
Oh, that's awesome. So it seems as if an investor will not necessarily make money until maybe the homeowner is planning to sell. Is that correct?
Well, that's one of the challenges of this type of asset, and it's the challenge of any type of equity-based investment, where if you don't have a yield, let's say you're an owner of a property, you're the equity owner, you own it, then in most cases, the rent probably just about covers the debt servicing costs and the management. So you're really waiting for the property to appreciate and to be sold to be able to get your payoff. So this is very similar to that. And the difference is with our platform, you can accelerate that liquidity by selling or having a trading environment where you can actually sell your shares or you can sell your investment as if it were a stock market for real estate.
Okay, and that was going to be my next, question, because if I cannot get any income, for example, if I'm invested in the stock market, at least I get some quarterly dividend, or annual appreciation. And I think what you are saying, it's about appreciation, capital appreciation, if the property should appreciate, right?
Yes.
But you also had a piece, which is you can trade your shares. Now, the next step is this publicly traded? It's, if I need to trade, then it has to be public, or is it like a private kind of trading right now?
It's a private trading environment.
Okay.
So that means that, and again, we haven't launched the trading side yet.
Okay.
Very soon, in the next week or so, we'll be launching the investment side. So you'll be able to buy the investments, but the trading platform element is going to be launched later on this year.
Okay.
But it's a private marketplace.
Okay.
So it's not public. So obviously, we can't make any promises or forecasts about how much liquidity there's going to be. So one of the risks, obviously, about this type of investment is we're not sure how much momentum or how much liquidity there's going to be, or how much activity there will be to start with. But looking at all of the other online real estate platforms, we know that they're all incredibly popular, and billions of dollars have been invested through those platforms. So we're pretty confident that with this asset class that gives that solid downside protection, as well as that accelerated upside potential, we're pretty confident that there's going to be a lot of interest in our secondary market.
So how long have you been doing this, Matthew?
Well, we've been working on this really for 4.5 years. And so we launched this concept and the platform in March 2018. And again, everything was very early on at that stage. So home equity agreements were very much in their early stages. They were beyond infancy, but still sort of, early adolescence, I would say. The blockchain technology that we needed to use to make these assets able to be tokenized and traded, again, very much in its infancy. So over the last 4 years, we've seen a lot of change in the adoption of home equity agreements by homeowners and their understanding of what these are as potential new ways of accessing your home equity. But we've also seen a lot of development and improvement in blockchain technologies that make it much more possible for us to use that as the foundation technology for our exchange.
Oh, good. So you launched about 4 years back, 2018. Are there other companies in this space? Like, as I told you, this is completely new to me. I just want to
yes, there are, and a good
yes,
there are.
Yeah.
There are a growing number of companies that originate home equity agreements for homeowners that want to access their home equity. But we are the only company in the world, I think, that is enabling smaller investors, accredited, and later this year, we're planning on opening the marketplace up to non-accredited investors. Again, that's subject to our applications being qualified by the SEC. But we're the only company that create a marketplace for this really exciting and interesting asset class.
So far, what has been the response from homeowners? How are people adopting this? Do you think people... I think it's a new concept that people that are seriously in need of cash, they will find it beneficial. But I just want to get a sense of how are people adopting this right now. Are people enrolling or signing up for your service right now?
Good. We're seeing tremendous growth, month-on-month growth.
Awesome.
And that's driven by a number of factors. First of all, it's very expensive to borrow money now. So if you've locked in your mortgage rate at 3%, and the bank's quoting you 6% for a refinance, that's not tempting. So interest rates are high. Also, no one knows where interest rates are going to go. So if you have a HELOC and it's based on market rates, and people are afraid that the market rates could be 15% at some point, like they were a few years ago. So no one really is very confident. So that's driving demand for this type of equity-based solution. Also, people are finding it more difficult, I think, to borrow money. Maybe their credit scores are not as high as they used to be. Their debt-to-income ratios may be a little too high in some cases. So there are a number of people that cannot borrow money or cannot borrow money on the terms that they would like, that find this type of agreement really attractive because they get a cash lump sum with no monthly payments. And I think that itself is also very attractive to people that can borrow money but simply don't want to. And those are people who are retired, for example, or have significant equity in their homes and want to diversify out of their home as being this single concentrated asset. And so those people are also exploring home equity agreements as a way of unlocking large amounts of capital from their home equity, which they can then use to invest in other types of securities or investments. So they're diversifying out of their home equity into other, a wider range of investments, some of which might actually generate cash flow. So they're swapping their home equity for investments that are producing, an annual or a monthly yield.
So I know your company is located in California. Is this product available all over the country right now?
Well, we are originating and funding our own deals in California. We're expanding into other states. Currently, home equity agreements are available in over 20 states, and that's through us and other companies. So it's not just restricted to California. You'll be pleased to hear. It's, sadly not Texas, though. And I tell you why, because there are a number of, in some states there are localized real estate regulations that are incompatible with the structure of a home equity agreement. And Texas is unfortunately one of those states where its real estate laws make it very difficult for companies like us to offer home equity agreements. But we're available, or these types of agreements are available in over 20 states.
Cool. So I'm going to put on my investor cap on for a minute. Now, let's say I want to invest in home equity agreements,
yes.
To buy some quantity of shares.
Yes.
When the investors opportunity comes out, and I put in maybe $100,000. If the homeowner of that property should default, the bank, they can foreclose the property, right?
Yes.
How do I make sure that my investment is protected? Because at the end of the day, investors, they need to have that confidence and assurance that their investment is safe. What are you doing about that?
Well, that's a very good question. And one of the most important things that we do is we don't invest in more than 25% the current value of the property.
Okay.
And secondly, if you add our investment to the existing mortgage, which you can't increase after we've signed the agreement with you, together, our investment and the mortgage will always be no more than 75% of the current value of the property at the time we go into the contract. So if the homeowner defaults on their mortgage, there's a number of things that we can do because we're partners with the homeowner to a certain extent. What we can do is we can help pay the mortgage for the homeowner so that we can then have a orderly sale. So rather than the homeowner going into default and being foreclosed on, at which point the bank comes in and snatches up the property, it can be sold at auction and the value of the property isn't fully realized. What we can do is we can work with the homeowner to keep the mortgage payments current and help them sell the property where they can get maximum value for it. And that helps us get a maximum return for our investors. But also, the home would have to depreciate significantly because of the amount of cushion that's still there. So we're not increasing the leverage for the homeowner. By giving the homeowner cash without debt, we're putting the homeowner in a stronger position than they were before our agreement. So in many cases, the risk of the homeowner defaulting probably goes down considerably after they've received cash from us. And obviously that's on a, depends on the case-by-case basis, but we're not increasing the leverage, we're not increasing the monthly payments, we are increasing the amount of cash the homeowner has. But I think the combination of that and the equity that the homeowner remains with after our transaction, together with the types of properties that we invest in, I think all of those factors help reduce or mitigate these types of risks. And obviously you can't get rid of them altogether, but we can mitigate them as much as possible.
Cool. So let's say a homeowner comes to you today and they sign a contract with you to borrow some money, $50,000. About a year down the line, this homeowner is interested in paying you back.
Yes.
Is that possible?
Yes. And the great thing is they can do that with no prepayment penalties. And in fact, what we do is we offer an incentive or a cap on the amount of return that we can make, so that if the homeowner does decide to refinance or buy us back after a year, then they'll actually pay less than that 32% of the share of the value of their property. In many cases, substantially less. So we cap the maximum amount that we can earn in any 1 year. And so that really encourages homeowners to think very carefully about maybe paying us off early.
Okay. No, that makes sense, because things may change. The homeowner may decide that, let me go pay them back. So I want to be sure that that is possible. And one other thing, are there requirements or criteria that you look at before you offer money to any homeowner? For example, banks will look at credit score, they look at debt to equity ratio, all those information. Are there things that you guys look at as well?
Well, yes, we do. And we go through a very comprehensive underwriting process. But we're very much focused on the property itself rather than the homeowner first. Like if you're borrowing money, you're looking at the homeowner's ability to borrow more money. So you're looking at things like credit score or debt to income ratio, those types of things. We're looking primarily at the property, its ability to appreciate. And then we're looking at the homeowner's ability to make sure that they can keep their repayments on time. So from a homeowner's perspective, we have a minimum credit score of 500. That's a lot lower than many banks or most banks. We ask that if you that you do need to have kept your mortgage payments up to date over the last 2 years. You do need to be not bankrupt, obviously, or if you were bankrupt, 2 years at least must have passed since your bankruptcy was discharged. And really, we're looking at other, primarily fundamental underwriting questions about the property. Where is the property? If it's too rural, normally we wouldn't be able to go ahead. If there's more than 5 acres, for example, if the property is run down, if it's not properly maintained, then these are all the sort of underwriting decisions that we make. But they're primarily focused on the property first, rather than the clients or the customer or the homeowner's ability to borrow more money.
Awesome. So I know that you've been in this real estate space for quite some time, and you've mentioned blockchain technology quite a few times. Now, like I said earlier, home equity contract is quite new to me. Do you think this idea of home equity agreement can be the next big thing when it comes to real estate assets?
Yes, and the answer is resolutely yes, because of a number of factors. So first of all, the size of the addressable market is enormous. There are, if it depends on where you look and what you include, but there's about $18 trillion of equity in residential real estate in the US. Now, obviously, not all of that is available to us, because some of it's just a small piece, so the homeowner wouldn't qualify. But a good fraction of that, at least half of that, is available equity. So, the market is measured in trillions of dollars. Secondly, you can't access equity upside in owner-occupied properties at the moment. You can if you own the property yourself, but you can't benefit from the equity increase of your neighbor's property right now. And you can through a home equity investment. So what that does is it does open up a new asset class that's measured in trillions. And the other most important thing is it solves a real problem for the homeowner.
Right.
Now, if the homeowner had no motivation whatsoever to sell you some of their equity through a home equity agreement, then you'd be a bit stuck. But the fact is that homeowners are very keen to consider this type of option because of the value that it brings them. Cash with no monthly payments, with no debt, that allows them to spend it on whatever they want, where they've got, in some cases, up to 30 years, depending on the state and the company, to settle their agreement. So it's a very useful agreement from a homeowner's perspective that can be used instead of or as well as HELOCs or cash out refinances. So it's a very useful product. So I think for all of those reasons, we are and continue to be very excited about the prospects for home equity agreements and tapping into this completely unused and uninvested asset class.
Indeed, I see this as a way to create a win-win situation as between an individual that needs money urgently and investors that just want to make sure that they have that capital appreciation. So this is good. So Matt, as we are rounding up, how can my listeners, people that are listening right now, how can they reach out to you or connect with you so that they can learn more about the products and see how they can tap into this opportunity?
Sure. Well, everything is on our website, which is www.quantmre.com. So it's QUANTMRE, QuantmRE.com. So there's a calculator that is on there that allows you to find out how much home equity you could potentially unlock with us. We also have the investment side of the business. So if you want, you can go on, register as an investor, and that gives you early access to all of the new deals that we'll be bringing on very soon. And there's a whole host of information, a downloadable guide, podcast videos, and all sorts of other information material for you to listen to, watch, and look at, and so that you can become more involved, or you can understand more about how these types of agreements work.
And that's it. It's a wrap. Guys, if you want to connect and learn more, please check out QuantmRE.com so you can learn more about this product that Matthew is talking about. Thank you very much, Matthew, for all the details, information.
Fantastic. Thank you for having me on. It's been really enjoyable. Thank you.
All right.